AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us today. What's this, the fourth show of the year?
Last show of January 2021, to be more precise.
It's the same show we've been doing for the last 11 years, and we appreciate everybody listening. You're always welcome to call the show. We are live, 800-516-1220, 800-516-1220, with any of your questions about real estate or mortgages, and it is a big topic for a lot of people. We know that 2020 would have looked a lot more dire than it did if it wasn't for the real estate market, Gordon. That's all we're hearing about, all the big numbers and record sales pace. We're back almost to what it was back in 2006 as far as existing home sales. And there's a lot of really interest rates, home equity, profit on the sale of properties, which we'll talk about today, as well as flipping properties, or you call resale properties. Investors are making rents are up. It was just a banner year, but as real estate is, it's just a big part of the market here in the United States that we can't ignore it, and we're going to see this continue through 2021.
Well, if you isolate the real estate industry, which is probably the biggest industry in the country, it had its banner year on all facets attached to real estate. Talked to a few realtors. A lot of them told me this is the most money they've ever made in 2020. Talked to one of my title persons today. Told me this is his most profitable year he's ever made since he's been in business for 27 years doing title. So a lot of things associated with real estate, yes, have been rolling simply because if you look at the prices of real estate. Look at the values and the prices of real estate. So if you take a house that was averaging $300,000, now it's averaging $600,000, you need to sell half the amount of houses to make the same amount of money, assuming you're making a 2.5% or 3% commission consistently. So that's the reason why all these people are making I'm going to say making so much money, are more profitable than previous years, because what's a lot of money is a different variation to different people.
Plus, a lot of people, a lot of professionals that were in the business coming out of the Great Recession left the business, Gordon. That was the one, I guess, silver lining coming out of the Great Recession as far as real estate is concerned. A lot of people that had taken advantage of loose guidelines, shady practices, the compensations, the rules between compensating, referrals and things like that. That all went away, and it weeded out these people who were taking advantage of that, and it left a really good pool of professionals in the business. And then the business slowed down a little bit and it shrunk. But it did leave that core professional, environment out there for people to access. And not only that, there were some really smart people that just took advantage of good technology. That was another good silver lining out of 2020, regardless of COVID and how that's affected you. Technology in real estate and especially when it comes to mortgages. Everybody knew we had DocuSign and things like that. But it's really about how, when you have over 50% of the people that are buying houses, putting offers in on houses sight unseen, that doesn't mean they're not seeing the house. They're seeing it through virtual reality. And that is really what it comes down to, is the technology has kept us going through this crisis that we had last year and made 2020 what it was.
Well, technology became to the forefront. I talked to a lot of different people, a lot of elderly people had to grasp on technology. I was talking to one of my neighbors. She said, I order my groceries. She said, the only thing I knew how to use my phone was to make a phone call before this whole COVID crisis. Now everything else I do on my phone, simply out of necessity, simply after altering her game plan based upon the current circumstance we're in. And I think it's made us and all people around us much better people when it comes to technology, much better when it comes to problem solving. It's kind of really, really moved us to the forefront that we've been slowly to get to, even though we should have been there previously before this whole thing happened.
With that said, it's still interesting to see articles that say loans still taking 2 months to close, refinance demand stays strong. Don't listen to that. All right.
Well, there are some loans that are taking 60 days to close.
But this is not the average here in the Bay Area. There are some very, very smart people here in the Bay Area that do very good jobs for you, including including us.
I disagree. It's not our average, but it's a lot of other people, competitors' averages, because I talk to a lot. We get a lot of loans that are people that are on the grapevine still waiting for their loan to close. Matter of fact, we just got a call from our previous employee that used to work here, moved to Las Vegas, is buying a house in Las Vegas. He said the realtor referred him to one of these online guaranteed rates. He says this is going on to the 60th day and they still haven't closed yet. So there are people out there that are taking 60 days to close, not us.
It was interesting to hear his rate. I overheard the conversation, 3 1/8, which right now Fannie Mae and Freddie Mac, or really Freddie Mac, is averaging 2.73%. That's down, 3 basis points from last week. And we did see some really big up and downs over the last couple of weeks, and it's leveled off at a very nice rate right now. We might as well talk about this while we have it. There are a lot of lenders out there, including 2 or 3 investors that we use right now that are offering pricing specials. Pricing meaning you can get a better rate, or a lower rate costs you less if you are just W-2'd and you don't own any other property. So if you own a primary residence or an investment but rent, if you own a primary residence and you're W-2'd and that's it, you will get a better rate than somebody who's self-employed, because they want it to go through fast and easy. They don't want the underwriter to touch it more than once, and they're done. So yeah, there are better rates out there for people who are W-2.
Well, if you just said that other competitors are averaging 60 days on the vine as far as closing time is concerned, this is one way you can speed it up. If you have a simplified application, person W-2, simple pay stub, a lot of information now are accessible online. You don't have to track the customer down for this information. These loans help increase these companies' turn time. That is the reason why they're offering specials like that, because that helps their picture show up on the web that they're closing days and average 30 days instead of 60 days. That's the reason why they're giving the extra rate premium for those type of programs.
Well, what I believe has happened as well is what happens when there's a product, whenever there's and we see a lot more products in what they call non-QM environment or jumbo. Whenever there's a new product that comes out, there's always some investor, some banker that has made this product and is selling it. He says, okay, these are the guidelines. I ran the algorithms. We can sell it at this much. And then he goes to all of the investors and say, this is how you can sell this product. And then it pops out. I think this is a new product. I think that this is not getting mixed up with people who are self-employed and or have rental property that makes their files a little bit complicated. I think they're actually selling this at a better rate.
Actually, no, I don't think it's actually a product. I think if you understand what we call the back office of banking, you can get better pricing on shorter periods of time. So these type of applications you can close in a shorter period of time. So therefore you can get better pricing. And if you look at, we talk about closing and locks all the time. People call a 15-day lock is better priced than a 30-day lock, better priced than a 45-day lock. So the longer a lock stays on the grapevine, the longer it's going to take, the more expensive it's going to cost you. So if you can write loans in an algorithm type system, which is strictly a W-2, you don't have to track anything down. You can close that loan in 15 days and get better price and offer that pricing onto the consumer. That's what they're trying to do. So they're going to make their money in volume, not necessarily in pricing.
But if it's the same product, that just means they're charging people that have other harder loans, they're charging them more. It's another risk factor. Why don't they just add it as a risk factor?
No, not necessarily they're charging more. They're making up it in volume. You're
still locking it for the
volume.
I mean, honestly, 1 or 2 days in underwriting isn't that much.
Well, but the underwriting less touches as we talk about. We don't have to go back and get the transcripts that we all need to use from the IRS that slows things down.
Yeah, but that's
if
the difference between
you get an appraisal waiver, no appraisal is involved, you can actually close the deals in a lot faster period of time.
You can't. I just don't. The price difference is significant. I think it's more significant than just that 1 or 2 or 3 days extra that it's going to take to underwrite a file just because it has a rental property. If you're W-2, look, rates are great. If you're looking to refinance and you haven't, now's really your chance. It is estimated that rates are going to go up. I'm not one of those guys who are going to say that, oh, do it now. You always do it when it works for you. It's gotten easier. It's not 60 days to close a loan. Most of our loans close in 25 days or less. It depends on the complexity. Jumbo loans a little bit more. VA purchases sometimes, they can be a little bit, when you have an appraisal involved, that can take a little bit more time. But we're seeing a lot more what they call appraisal waivers. Fannie Mae and Freddie Mac have opened up that kind of arena. They've changed their, let's use the word again, algorithm to help people with Fannie Mae and existing Fannie Mae and Freddie Mac loans. And by the way, you can just simply go to Google and say, who owns my loan? Does Fannie own my loan or does Freddie own my loan? And you can find out. And if you do, and we could do it for you as well, if it is, then these kind of waivers can come about in a certain fashion. We work on building your file to help you do that and make it work. That's important as well.
Well, yeah, one of the other factors you have to look at too, over the last 18 to 24 months, rates have been low. Volume has greatly increased. A lot of companies went out and hired and trained new underwriters. When you have a new underwriter, a new guinea pig, it's very easy to give them simplified loans that they don't have to worry about income analysis. They don't have to worry about rental property income, depreciation, tax, LLCs, all those type of things. So those loans can actually turn so much more faster because you have a lot of unexperienced people working. So that helps increase your turn time, therefore increases volume, make you more profitable through a volume incentive more so than a number of quantity of loans invested.
With that said, that doesn't eliminate the people that have more complex loans, rental properties, self-employed or corporations, and multiple rental properties can be a little bit more difficult. But with a good company, a good broker, a good loan agent that can put that together, and with your cooperation, that's the thing. It's funny that we see these repeat clients. They keep buying rental properties. They go, why does it keep getting harder? Because you keep adding more things to it. You have more paperwork, more assets, more liabilities that you have to kind of, put it all into one piece and come down with a number, your debt ratio, your credit score, what is it, your equity, the things that really matter in how this loan is underwritten. So we're not eliminating these people. The rates are out there for these people. Doesn't matter if it's owner occupied, 4-unit plus, rental. It could be condos. It could be townhouses. Everything is out there for the what I call managing your mortgage.
Well, let me remind you, we had an investor that told us that they didn't want those loans with people having multiple properties and multiple LLCs and multiple.
I think that's gone. But
once again, that slowed down their process, slowed down their pipeline, took away from the income.
Well, if you're interested in doing any kind of transaction, we're here to help you. You can always go to our website. It's BayAreaLoanSource.com. It's BayAreaLoanSource.com. If you want to get your questions on the air, it's 800-516-1220. 800-516-1220, or you can just simply email us, Tony or Gordon at BayAreaLoanSource.com. That's Tony or Gordon at BayAreaLoanSource.com. We'll come back after this break. I'm Tony Mendez. That's Gordon Hines. This is the Real Estate Report here on AM 1220 KDOW. We'll be right back.
Questions about real estate? Call the program, 800-516-1220. Now, back to the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
We're talking everything real estate and mortgage. You're welcome to call the show, 800-516-1220, 800-516-1220. We have several emails, in fact, that we're going to get to. Meanwhile, rates continue to be the mortgage rates, that is. Well, the Fed came out. They basically said that they are going to continue, their aggressive approach towards, the bond buying program, billions of dollars, each year, each month, and as well as the keeping their Fed's fund rate down as low as they can for a long period of time. And that was their Wednesday meeting. They're buying $120 billion dollars in bonds a month. That's crazy, and that's helping keeping that yield low, Gordon, and that's keeping rates low.
Well, if you look at the economics of what COVID has done, especially here in the first quarter of this month, I think this month has been record number of people are dying. We have to do some type of artificial prop up to kind of keep the economy going until we can actually work through this thing. The whole vaccine program, as we taught, is not working as it should have. So it's a little bit behind the times. So in order to get these things in people's arms by spring, I think they have to prop up the economy just to keep everything status quo. So everything doesn't break down until things get worse. Until things get better with the vaccine, I don't think we'll see a break probably until the beginning of the late second quarter, early third quarter of 2021.
Jerome Powell said that the economy is a long way from our monetary policy and inflation goals, and it's likely to take some time for substantial further progress to be achieved, and he said this at his post-meeting news conference. Policy will remain highly accommodative as the recovery progresses. And that's kind of what you said, as we see it progress, but they are going to stay highly accommodative. I think, as we see, and I think that really is what it's going to be, COVID, the recovery, the masses getting back out and, spending money and getting jobs is going to turn around into slightly higher rates down the road. It might look good on your portfolio. The stock market might react in much more positive ways than we've been seeing, even though we've recently hit new highs and pulled back a little bit. Those are the dips that we're going to see. And then we have the new administration's policies where, we saw today that, Biden wants to tax the rich. Is that going to trickle into the middle class or the lower class? And we don't know. Or is he doing that just to fund stimulus? Are we going to stop? Are we going to go back to, Fannie Mae and Freddie Mac conservatorship and see more money going back into the Treasury from there because they're making billions and billions of dollars? I don't say it's fair. Let's keep that going on a little bit longer. There's no reason why the homeowners can't continue to get good rates, and that money trickles back down into the economy as well. I think it's going to work this time, the way they think it's going to.
Well, nobody ever wants to pay more taxes, but if you look at, once again, the Treasury, if we have to prop the economy up, we have to actually hand out free money, the stimulus checks, that's all money coming out the Treasury. We have to make up some of that money somehow. Unfortunately, raising taxes is going to be part of the plan. I think we need to do more than raising taxes, though. I think we really need to, cut the fat, really go back and streamline and clean up a lot of our budgets. I think the problem in Washington is so many things that are actually wrong. They need to start fixing the wrong things, which eventually is going to lead to things happening right. And I think until they fix the wrong things, I think we're going to be in this crumple zone for a long period of time. Every president comes in is going to be doing the same thing. It's just like a losing battle simply because we actually need to take the time to fix Washington.
With that said, that is going to lead towards volatility throughout the year. Opportunities for people to, you might see rates go. Well, 2 weeks ago, rates were skyrocketing. Do you want to say skyrocket? Oh, went back up to 3%. That's not skyrocketing. Yeah. But yeah, we are going to see those kind of volatility throughout the year. But you just don't want to miss it. You don't want to hear it from a radio show. You want to hear it, or you don't want to read it in the news, because by the time you see it, it could pass. It happens that quickly in the market, and it might make sense for you saving $100, even if it's $100 or $500 or more. It may be the chance for you to take money out, and like this person here, David, he wants to take money out to renovate his house, and he says, should I refinance and take it out, or should I get an equity line? Equity lines are still more expensive than a cash out refinance. Why would you get an equity line? Right?
Actually, a lot of companies are no longer equity lines. Just found out this week, a couple of clients called me, went to a couple of the big box stores, and all of them have equity lines on hold simply because of the volatility in the marketplace. Those are the first signs that there are tough times ahead. And these are some of the big houses that normally advertise equity lines. They're all part of their portfolio. A lot of them are not stopped giving, just kind of put a temporary hold on moratorium simply until we kind of work through this development crisis here that we will be facing in the first quarter.
So speaking of which, as brokers, we work with multiple different investors to, kind of tailor your transaction to the right person or the right investor. We picked up a lender not too long ago, maybe 2018, that brought back their first and second, what they call simultaneous transactions. They go up to 89.99% loan to value. That means that if you're $1 million on your house, they'll go up to $899,999. And the rates are decent. You have to have a minimum credit score of 700 and debt ratio of 45 or lower. But they're back. You can do first and second combos up to 89.99%. So we're very happy to be able to say that.
Yeah, I think those are fixed rate sections and actually equity lines because once again they want to.
It's tied to prime.
I think they want to tie into something. A lot of times, most of the time, an equity line is a blank check. Lenders tend to hedge their bets. A lot of times, that's why they cut you off without even realizing it until you actually go to kind of write a check and that check comes back returned because they're not honoring those checks. It's an interesting business. I think it's something we all got to work through. Everything is a managed crisis. We all talk on the show. Financial planning is very important. Wealth management is important. Everything is important when it comes to your finances. And of course, we're dealing with the biggest part of your finances, which is your primary residence. And that's why people listen to the show every week. And we kind of give advice and kind of push people in the direction that we think they should be keep going because we have information to help you be a better consumer.
Well, this is an email from David in Sonoma County's, and we appreciate the email. You can always send the email, Tony@BayAreaLoanSource.com. He owes $400,000 on his house. It's worth about $800,000. He needs a bigger house. I guess his household is increased. He wants to add about 750 square feet. We looked at an equity line, but they're not lending high enough. Well, this is one of the cases where it could, going up to 89.9%. But when you start looking at, the costs of doing that, another transaction like that, plus it's such a higher LTV, and his property value, they don't use the future value of the property, so it pushes the rate up a little bit. You can use a construction loan on this. Instead of getting an equity line or private money, you can use a construction loan. There's two of them. There's something called Fannie Mae Homestyle and FHA 203K, and then they have also the Streamline. These products use the as completed value of the property. So if he wanted to keep his loan to value low and he wanted to stay in the conforming limit, which is $822,000 in most of the counties here, and it drops a little bit as you get farther out, you can use these products to get a home loan for renovation. And they do the same thing like a construction loan where they do the draws and everything like that. But these are fantastic products. We have the best company. They do about $400 million a month in California. If you're ever interested in doing something called a Fannie Mae Homestyle, they're for single family properties, investments, or your primary. I should have said that the other way. Primary or your investment. So as long as it's a single family. So these are fantastic products. We have them. If you're interested in that, and David, thanks for the email. You can always email Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. We'll be right back after this break. You can call the show 800-516-1220, 800-516-1220, or email the show Tony@BayAreaLoanSource.com. We'll be right back after this break.
Phone lines are open on the Real Estate Report. 800-516-1220. That's 800-516-1220.
Going back into the Real Estate Report, my name is Tony Mendez.
And my name is Gordon Hind.
Thanks for joining us today. So as rates are low, a lot of people are going to be looking at refinancing. I guess there's kind of a theme today about refinancing because like I said, we're going to see rates go up and down last week, and it skipped the survey. Did you know that when Freddie Mac does a survey, they heavily weight Monday, then they do a little bit less on Tuesday, a little bit less on Wednesday, and so on. So if rates are lower on Monday, but they're higher later in the week, it's still going to look like they're lower.
I didn't know that.
You didn't know that. So all it is a trend. Okay, this rate may or may not pertain to you. 2.73% according to Freddie Mac weekly survey. You could be in a high balance loan. You could be taking cash out. Your credit score could be lower, or you could be a W-2 employee with good LTV, what they call regular balance conforming Fannie Mae loan, and your rate might be lower with a higher credit score. So there's difference. This is an average. That's all it is, and it gives us a trend. As people look to refinance some of the myths that are out there, you might not save as much money as you think on a refinance. That's not necessarily true, is it, Gordon?
Absolutely not.
It's all about, especially when you have that new flex loan that we have, where let's say that you are 6 years into your loan, you can get a 24-year loan. So and you can look at the real savings. I was paying, $2,000 a month. Now I'm paying $1,900 a month. 19 times, 280 something months equals this much money saved. I mean, it's that simple as far as the formula goes. Even if your loan balance goes up, your payment goes down a little bit. Sometimes it makes a lot of sense. And then you had the scenario about the 15-year, Gordon. You had somebody, I think it was Bill was his name. You were trying to convince him to do a 15-year, and he opted for the 30-year. So it goes either way. You can save money on a monthly basis, or you can save money on interest.
Yeah, Bill called this week and wanted to get some rates for refinance. He was referred by the client. He has a small loan, $250,000. He said he wanted to pay off his car, which is about $20,000. So we're looking at a small loan about $270,000. I think Bill's 52 years old. By the time we ran through all the numbers around his credit, I think by the time you look at the savings based on where he was before we start looking to refinance, we can probably save about $1,000 on a 30-year mortgage. Of course, once I looked at the numbers, he makes good money because he works for a big manufacturing company here in the Bay Area. I said, Bill, listen, it's a small loan. You're 52 years old. I would strongly recommend a 15-year term. Of course, a 15-year term, he's only saving about $346 a month. He thought about it, and he came back and said, well, I prefer the 30-year.
He wanted money now instead of later.
He wanted money now. I was kind of disappointed. I didn't want to kind of, string his arm to tell him, look, I'm giving you a better deal. But once you run the numbers, I said, look at the numbers. You're 52, 15 years, you'll be 67, your house will be paid for rather than 15 years, you'll have another 15 years to pay your mortgage. But he couldn't see it. He says, well, I'll just make some extra payments towards my principal. I said, listen, you might do that for the first couple of months, but as your money streams come in differently, you won't have the discipline to continue to do that. 15-year paid dividends, but he couldn't see it.
Sometimes that is an option for people, Gordon, just to get, so they don't feel locked into that 15-year payment. They go to the 30 and then they make the payments on their own. Some people, instead of, they write an extra payment every year, or they do biweekly payments. Sometimes that feels a little bit more comfortable, especially around here in the Bay Area. A lot of people are getting RSUs, they get some bonus, they get extra commissions, and they decide that they want to pay it. But during that time they don't have those bonuses or large chunks of money, they want the lower payment. So with low rates like this, it gives you options. That's the real kicker here, Gordon, is that there's options.
Well, he has options, but you got to look at the best option. That's what he called for. That's what we tried to give him. Unfortunately, he went with the 30, which we were okay with, but the 15-year was a better option in this particular circumstance.
We're here to help you. You're welcome to shoot us an email, Tony or Gordon at BayAreaLoanSource.com. You can also call the show, 800-516-1220, 800-516-1220. And our website is BayAreaLoanSource.com. I'm Tony Mendez. That's Gordon Hines. This is the Real Estate Report on AM 1220 KDOW. We'll be right back after this break.
Got a question? Run it past these guys. 800-516-1220. It's the Real Estate Report with Tony Mendez and Gordon Hines on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us today. I do feel like a fool in the rain yesterday. Oh, my goodness. So we've covered a lot today, and as rates are the way they are, there's still people out there, Gordon, and it. We've seen people in FHA loans, lower credit scores that have now gotten better. We've seen equity build. We've seen people build up debt. We've seen people take cash out to buy property. All of these things are we've seen people get divorced. We've seen people just remove people off title, inherit property that need to buy it and then refinance it. People doing construction on their property with private money need to get out of it. They've been in what was the most popular product pre-COVID? Non-QM. A lot of people were in non-QM. Did they have an exit strategy? Yeah, they want to refinance. So there's so many reasons to refinance, and then you got to be careful of the myths that are out there. One of them is you need 20% equity. If you're in a jumbo, you can turn off the radio, okay, or change the channel, because right now there's no non-QM products that go over 80% in the jumbo market. But if you're less than 822,000 here in the Bay Area, the immediate Bay Area, you can do less than 20% down. You can have less than 20% equity and still refinance. There's something, and you're worried that maybe you'll have mortgage insurance. Yeah, you can get mortgage insurance, or you can build it into the rate. And rates are so good. We have a client in Elk Grove that bought his property with 3% down. His equity went up. His property value went up. His balance went down, and then he refinanced again as rates went down. And now he's refinancing again down into below 3%. With still less than 20% down or equity.
Well, we hear a lot of different reasons when I talk to clients about refinancing. Sometimes I call some of my old clients, and a number of reasons why my credit is not good. A lot of times people miss the timeline on the mortgage payment. They're not quite 30 days late, but they paid past the grace period, so they think the credit actually has blemishes. It actually doesn't. You don't get a blemish until you pay into the next month, actually. A lot of times people think they don't qualify because they keep hearing all these myths about what's going on in the world. They don't think they qualify. A lot of times you can qualify. People on fixed income, sometimes we can adjust the income by 20% based upon the direct deposit, meaning no taxes. So a lot of different options out there when it comes to those myths. So I tell people, don't make a decision on your own. Check with us first. Let me tell you, you can't refi or you don't qualify, rather than you telling yourself. And I think that's why a lot of times we see the serial refinancers, the people refinance every year, when we have a lot of people out there just keep these high rates for a long period of time because they think they don't qualify, and that's one of the biggest myths that you were just talking about.
Well, yeah, I mean, especially when they're dangling it right out in front of you every day. It's one of the first things you see on any kind of financial, or in regular news or financial news is low rates. Something you brought up as far as the type of people who are hesitant to refinance or may have heard otherwise are the people who went into forbearance. You can go into forbearance. You could have been in forbearance for all of last year. As long as you made your last 3 payments and you're out of forbearance, you can refinance. There are lenders that will pick you up right now. That's because the way that they set up forbearance is that it doesn't show lates on your credit. and it doesn't affect your credit, but it does say forbearance. So as long as you can prove that you're out of forbearance and you've made your last 3 payments, boom, you can refinance. So there's a pool of people out there that may just not know, because we were talking about this earlier today. And it was a little bit of an argument, but I don't think there's the right amount of education. You can buy a product. What you said, why, if I'm selling a product, do I have to tell you how to use it? That's what happens in the finance. The same thing happens with Equidine. Same thing happened with banks saying, oh, yeah, well, we'll do a short sale, but you got to stop making your payments. They're not educating people.
Well, a lot of times people don't educate themselves. People go for the soundbite. People go for the gimmick, that they hang on the door rather than reading the fine print. A lot of times people don't want to hear the fine print. That's what I find. A lot of times people, they can hear something and then you can prove it's wrong and they still believe it simply because they hear what they want to hear. People like to hear what they want to hear. So a lot of times it's the same thing in our marketplace. People get these myths about what they can and can't do, what my neighbor didn't do, or what my neighbor did do. Like financial circumstances are completely different, but they're measuring themselves by that neighbor stick, which is a complete inequity, trying to measure yourself from something you don't really know. But that's the decision they come to make a bad decision. And that's what happens a lot of times is when we come to education of who you are. There's a lot of tools out there in the marketplace that we always talk about. You should actually know what your credit score is. You can actually know what your debt ratio is, because there's so many tools now that are at your technology finger on your phone that you should actually get to, that you don't need one of us to help you through.
And that brings up a good point about if you go around enough, it doesn't matter what you're shopping for, you're going to eventually find somebody who's going to tell you what you want to hear.
Absolutely.
And that's the hardest part about the business, is that not just the real estate business or the mortgage business or, insurance or even annuities. We hear a lot of people selling annuities and they're like, they could be really good salesmen. It might not be the product for you, or whole term, or whole life insurance, or term life insurance. Which one makes more sense for you? And if you run across somebody, they're finally going to convince you that this is the right thing to do.
Well, a lot of times the one that's more profitable always makes the most sense to you, because that's the person, the way how the salesman is actually pitching it to you. He's not pitching to you false information. He's just pitching to information in a way that the more profitable product you're going to go for, of course, it's going to make him.
Well, you remember what it was like back in 2004, 5, and 6, and 7, even, where we weren't selling the clients products. The lenders were coming to brokers and saying, "This is the product that will make you the most money. Sell this product." And that's what all the banks and brokers and loan officers fell for, was what made the most money, not what was best for the client. And that's why Dodd-Frank, and coming out of the financial crisis we had, we're overregulated.
Well, we're supposed to,
because it's consumer-based service now.
Right. Well, if you go back to Truth, there's always should have been truth in lending, but of course, truth in lending kind of got distorted back then. And that's the reason why we had to redefine what truth in lending is, what qualified mortgages are. And I think once the market redefined it and reset it, we made everybody responsible. We made everybody have a license. Everybody's now accountable to someone. Appraisers are accountable to the Appraisal Bureau. Loan officers are accountable to the NMLS. Realtors are accountable to the boards. So these things make business better, because there's a watchdog, there's somebody looking at you, and there's punishment if you don't follow the actual rules.
And this eventually does trickle down. This is going to sound funny, but it trickles down to lower rates. If you follow the ability to repay rule, the qualified mortgage rule, it allows that your mortgage-backed security to be sold at a premium rate, which means that you're going to get the lower rate. That's why you go what you go through to get these lower interest rates. Now, we talked about earlier about how W-2 employees and the cookie cutter loans are getting a slightly better price cut. But you still have to go through the motions, just like somebody who's self-employed or has multiple investment properties, or corporation, or own their own business. Well, it doesn't matter. Everyone has to go through their motions to get these prime rates. That's why we always believe that the harder the loan, the lower the rate. The easier the loan, the higher the rate. That's where non-QM came out. The non-qualified mortgage products came out. Oh, you can do bank statement products. Oh, you can do stated income in a way. You can do interest only, 40-year terms. You can be foreign national. You can do higher debt ratios. You can do higher cash out limits, things like that. That's when you start getting away from those cookie cutter loans, those A-paper, Fannie Mae, Freddie Mac, FHA, VA, USDA loans. You get higher rates. The farther you get away from that, you're getting higher rates.
Yeah, sometimes people are very conservative or are very secretive about their finances. A lot of times people don't like to give information up. You're asking too much. They give you one page of their bank statement. We need all the pages. And these are all the things
they black it out, their name and their account number.
These are the things we fight through to try to make sure that you qualify, make sure we close your transaction, and that's why we are here. We're not asking this because we want to know. We're asking it because it's actually required.
We're here to help you. You're welcome to shoot us an email, Tony or Gordon at BayAreaLoanSource.com. That's BayAreaLoanSource.com. Or you can call the show, 800-516-1220, 800-516-1220. I'm Tony Mendez. That's Gordon Hines. This is the Real Estate Report on AM 1220 KDOW. We'll be right back.
Tony and Gordon are taking your calls at 800-516-1220. It's the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Home sellers are reaping record profits in 2020. So that was one of those records that 2020 made at $68.8 thousand on average. It's the highest per sale, is the highest figure since at least 2005, according to Adam Data Solutions. That's a pretty big number on average, considering that the median home price in the United States hit an all-time high of $266,000.
Wow, what a far stretch, 267 to what the median price here is in California. I mean, that's a huge difference. Going back to we were talking.
I think that's wrong. I think it's actually 322, if I'm correct. I think,
but still, if you're a real estate person, you're making a 3% commission. There's a lot of difference in dollars between a median price of 266 versus 366. So there is the numbers and volume and how it makes sense. When we talk about values and prices, we talk about real estate here in California versus real estate around the country. The difference in the areas, difference in pricing always affect the bottom line.
When I did my first home loan years ago, I did it with my neighbor. She worked at a mortgage company. I asked her how many loans she does, and she goes, "Well, I do about 15 to 20 loans a month." And I said, "Wow, that's amazing. That's really good." And now I'm in California, and many years later, and I'm looking at 15 to 20 loans a month would be pretty substantial
that'd be very financially
any realtor or any loan officer.
Yeah.
Then you go back and you look, and her average loan was about $100,000.
Wow.
And the average loans here are easily $400,000 or $600,000. So you can see how that is helping people in the real estate business all across the United States, and that turns right back around. That filters into the economy.
Well, the more money circulation is what helps the economy. So the more the seller pays a higher commission, the seller gets a higher price for the house. The real estate agent makes a higher commission. He buys a higher price house. He buys a car. He finances different things, buy a second home. So it's all money in the economy is what we want. We want money to circulate. We want people to spend money. That's what stimulates the economy. We want people to go into saving patterns because it drives up money, drives up the economy.
Home prices reached new peaks in 97% of the metro areas that were analyzed by Adams Solutions, including New York City, Los Angeles, Chicago, Dallas, and Houston. The places with the loftiest price hikes were Milwaukee with 15%, Memphis, Phoenix, Birmingham, and Seattle. No surprise there. There's a lot of places, smaller cities, and you have, the attractive amenities like jobs in some of these other cities. The least gains were in Worcester, Massachusetts, Harrisburg, Pennsylvania, and Pittsburgh, and even Boston was only 3.5%. So there's a big move. There's a migration of people to the Sun Belt right now is where everyone's going. We continually talk about people asking Texas. Do you land in Texas? Do you land in Texas? Do you land in Texas? Austin, Texas is the number one looked at destination for people leaving California. It's the number one destination for people leaving places like New York, Washington, D.C., Chicago, and other large metropolitan areas. Texas, places like Alabama and Georgia, and even Arizona and Phoenix and Nevada are doing very well right now.
Well, Texas home price is a little bit cheaper. Of course, there's no sales tax, and I think there's no income tax in Texas, if I'm not mistaken. But of course, there is a huge property taxes in Texas. Property taxes are huge. One of the things we always talk about when we talk about the South, we talk about the some of the southern states, how they're behind the backwoods. I heard this morning that, believe it or not, Arkansas, they're one of the number one states that are actually doing so well in vaccination. They've got almost 80% of everybody 65 years or older vaccinated. Kind of interesting. They've got the approach that they're using. They'll come to you. They'll do whatever it takes to get that vaccination done. And here is one of those smaller southern states that are way ahead of the curve. And some of the big states like California, we need to follow their patterns and follow what they're doing right.
Get rid of the red tape.
Absolutely.
Yeah, there's definitely some things we need to fix. I thought I overheard somebody talking about how a truck with vaccine broke down on the highway and they had to give vaccine injections on on the side of the road.
Yeah, because they're saying that the vaccination would actually have gone sour if they kept them too long in refrigeration. That's one of the problems with some of these vaccines. The refrigeration requirements are so excessive that a lot of times it's really hard to get these vaccinations out to the public. That's the reason why everybody's waiting on pins and needles, waiting for that Johnson vaccination to come out. I think this is going to be a one-shot deal instead of a two-shot deal. So there you have it. So we'll see in time how it's going to pan out.
Well, 2021 certainly is going to have some challenges. A new presidency. We have COVID still trying to figure itself out. Jobs didn't look good. The unemployment numbers still aren't really panning out, but low interest rates continue to fuel the real estate market, the mortgage market, filtering money back into the economy. It does feel like a lot of people are being left behind. The have-nots, that is, and the haves are doing a lot better. The haves, getting record gains on the sale of their property, getting record rates on the properties they've owned. The stimulus checks. We did see some bumps here and there in the economy as far as growth when that came out, but I don't think that's enough. I think we really need COVID to end, and we need to see people get back to work. And I think real estate will benefit from this even more so as we see builders just kind of hanging on the edge right now as far as building more. The confidence is pretty high, but I think they're just kind of, toning it down a little bit because they don't really know how soon. But they can turn that on like a switch. They can just go boop like that, and they can build. Well, you
have to look at the permits department. The number of permits pulled is going to tell you where a house is going to be in the next quarter. But speaking of COVID, this day in history, this is the time to show where we're talking about it today. Back in 1986, Space Challenger dropped out the sky, and all the astronauts got wiped out.
I think I was driving a pizza when that happened.
Yeah, I was at home 8:00 in the morning when it happened.
Wow. No, it wasn't. Was it 8?
Here, no. California.
Oh, yeah. Well, see, I was driving a pizza in the morning. Yeah. All right. We'll come back next week. Thanks for joining us. You can always shoot us an email, Tony or Gordon at BayAreaLoanSource.com. That's BayAreaLoanSource.com. We appreciate you being with us. I'm Tony Mendez. That's Gordon Hines. This is the Real Estate Report on AM 1220 KDOW. See you next week.